Well, welcome back to Finance Uncut. On today's episode, gold demand skyrockets. Last month, we had Palantir come out and buy Fiscal gold, warning of potential black swans. Also last month, we had Ray Dalio, who said that he has more gold than crypto. And he was saying you don't want to hold or commit to cash. You don't want bonds. And what have I been saying on this channel? I've been saying the exact thing. You don't want bonds. You want stocks, you want gold, you want tangible assets, you want real estate, Dalio said. And why is he saying all this stuff? Well, maybe because he knows that we are in a debt Ponzi scheme, that our economy is a Ponzi scheme. And guess what? Joe Biden, he all but admitted it. Check this out.
And in that case, we're able to borrow because we're always pay our debt. We always paid what we owe. We've never failed. That's America. That's who we are. That's what's called for. It's called full faith and credit of the United States. It's rock solid. It's the best in the world. But here's the deal. There's a cap on what we can borrow called the debt limit. And only Congress can raise or lower that debt limit. So let me be really clear. This is really important to know. Raising the debt limit is about paying off our old debts. There's nothing to do with any new spending being considered. There's nothing to do with my plan for infrastructure or building back better. Zero. Both of which I might add are paid for. So if we're going to make good on what's already been approved by previous Congresses and previous presidents and parties, we have to pay for it. Social Security benefits. The American people are promised salaries for servicemen and women, benefits for veterans. We're going to have to raise the debt limit if we're going to meet those obligations.
And in a tweet from Professor Richard Werner, who was commenting on the Guardian's article, A Perfect Storm, Supply Chain Crisis Could Blow World Economy Off Course, he says 1.5 years late, mainstream economists catching up with the reality that money creation or credit creation or currency creation, driven demand expansion plus government-imposed supply restrictions mean significant inflation. The central planners at least knew what they were doing. Absolutely they did. And I agree with the good professor. And futures slide on Evergrande, stagflation, and energy crisis fears. And Fed's Bullard sees inflation risks as Americans adjust to prices. Are people starting to wake up to inflation? That inflation is not transitory in the way that the Fed have been talking about. Yes, transitory means not permanent. So every single inflationary environment throughout history has been transitory. But what the Fed have been talking about and what the financial media have been talking about, transitory, meaning that these price increases that we saw were going to come down within a quarter or two, maybe a year tops. But that's not what's happening. And we're going to see an inflationary decade ahead with bouts of asset price deflation happening. When you've got asset prices severely overvalued, probably arguably at the highest valuations in history, as we move forward in the years ahead, there's absolutely no doubt in my mind that we're going to have some issues there. And will the Fed or will central banks ever fight inflation? Will they ever taper? Will they ever raise rates? I highly doubt it. I think there'll be some sort of accord meeting. Something will happen. There'll be some kind of reset. There's a lot of speculation as to what that might be. Because really, the Fed might be able to taper from 120 billion. I've said this before, maybe to 100 billion, maybe to 80 billion. That's about it. They'll never be able to unwind that balance sheet. They'll never be able to raise rates significantly to fight any sort of inflation. Could they raise rates 0.5%? Yeah, maybe. and they will see a correction in financial markets. But they won't be able to raise rates 2 or 3 or 4%. They just won't. They'll collapse asset prices. And we will see bankruptcies, defaults, you name it. And in breaking news, India imported 91 tons of gold in September compared to 12 tons a year earlier. That's over a 758% increase. Go India. So let's have a look at this article from Reuters that talks about India's September gold imports surging almost 8 times as prices correct ahead of festivals. India's gold imports in September soared 658%, I think they meant 758%, from last year's lower base as a correction in local prices to the lowest level in nearly 6 months, prompted jewelers to step up purchases for the upcoming festival season, a government source said. Higher imports by the world's second biggest bullion consumer could support benchmark gold prices, which have fallen nearly 15% from an all-time high of $2,072 in August 2020. The surge in imports could increase India's trade deficits and pressure the rupee. India imported 91 tons of gold in September compared to 12 tons a year earlier, the source said on Monday, on condition of anonymity, as he is not authorized to speak to media. In value terms, September imports surged to $5.1 billion from $601 million a year ago, he said. India's gold imports in the September quarter surged 170% from a year ago to 288 tons, the government official said. Last month, global prices were correcting and rupee was appreciating. The combination brought down local prices significantly and allowed jewelers to stock up, said a Mumbai-based dealer with a gold importing bank. Local gold futures fell to 45,479 rupees per 10 grams last week, the lowest in nearly 6 months. Retail demand has been improving and jewelry stores are registering good footfall, the dealer said. The country's gold imports in October could rise above 100 tons from 45 tons a year earlier if prices remain stable around the current level of 46,300 rupees, said a Kolkata-based bullion dealer. Retail consumers are now stepping out for shopping. The fear of the cerveza sickness has been going down with a drop of cerveza sickness cases. Indian authorities imposed localized lockdowns in the June quarter as the cerveza sickness infection surged to a record high, but allowed businesses to remain open or to reopen in a phased manner as cases fell. And from the In Gold We Trust report by Ronnie Stoffele in the chart deck, you can actually see that physical gold has been in tremendous demand over the last 12 months. And with India now back in the retail Indian market, back in the gold market in a significant way, this is absolutely going to increase that demand. And it's certainly way above the mean over the last, 15 years or so. That's for sure. And I've said this before in other videos, but central banks have been building up their gold reserves. And, how do we get out of this mess? Jim Rickards, Luke Roman, others really think there's going to be some type of reset using gold. It's really ultimately the only answer, the only way out. And it's a solid argument. And perhaps that is why central banks, and Luke argues that to do it, you need central banks around the world, increasing their gold reserves, and that's what we've definitely been seeing over the last decade. I think this chart really shows really well the M2 currency supply growth, the acceleration in 2020 and 2023. And this doesn't seem to be, at this point, it doesn't seem to be decelerating. And it definitely seems that we've moved into a quasi-type MMT world. And we definitely have seen this change from monetary dominance to fiscal dominance although I think arguably the fiscal dominance has been monetized or financed from the monetary authorities, the central banks, even through their shell game of dealer banks. And you got Joseph Wang, former Fed insider, that was on the trading desk at the Fed, and he argues it now is different. Professor Richard Werner argues that what is happening now is completely different to QE 1, 2, 3, 4, what we've had since the global financial crisis, that we have crossed the Rubicon, so to speak. And even on top of that fiscal dominance, Russell Napier, who has been a deflationist for 20 years, has completely changed, where he's now on the inflation bandwagon. He says the crucial structural change here is that the governments are providing credit guarantees to the commercial banking system, and now we have across the world bank credit growing really strongly in a recession, which is absolutely unheard of. And if you're not familiar with Russell Napier, I suggest you do so. Get familiar with him. Very, very sharp mind. And I think to make matters even worse is we're seeing energy crisis around the world, China through Europe. You can blame it on whatever you like, but I've studied the climate change movement. I've studied the energy sectors. I've invested in it. I've invested in so-called green, even though it's not green. Renewable, it's not renewable. I've made a lot of profits in this sector, but it's a sector I know well, and probably the best fund manager that understands this sector is Chris McIntosh as well, from Capital Exploits. And when we've been warning for a long time, you go down this ESG movement, this movement to move away from fossil fuels, you got to understand how things are built, how things are made. Everything in your household requires fossil fuels. Even the so-called renewable energy things, solar panels, need fossil fuels. It's an absolute joke, and people, the citizens of this world, have been duped. I've got to be careful what I say, or this video is going to be slammed by the tubes. But we saw this coming. So when you move away from fossil fuels and you think that you can just solely rely on, they're not even renewables, I hate even using these words, that you're going to see a lack of energy. And if you don't have energy security, you don't have the foundations of a sound economy. And so we're seeing energy prices skyrocket, where people are now trying to ration. We've got factories closing down because of the energy crisis. Fertilizer companies shutting down. This is going to impact, so it's not just the inflationary impact of energy. It's the knock-on effect. It's the transportation costs that are going to go up. It's the food producing and manufacturing costs are going up. That's going to be passed on. So by the time you get your food, one, there's going to be less food. Two, the food that you do get is going to be much more expensive, and also other goods and services. It's just crazy. So and now central banks are focusing on, we need to fight this, and we need to fight this cause and fight that. What the heck has happened to this world? I think every high school kid, every university kid should be made to read Friedrich Hayek's A Road to Serfdom, because we've ignored his warnings in that book. And I fear that the middle class and the poor are going to be hit the hardest. And this whole average inflation targeting, I think it's a cop-out. I think they know that CPI is going much, much higher. And they also know that there's nothing much they can do about it. They can't jack up interest rates. And so by just saying to people, yeah, look, we know inflation's at 4, 5, 6, 7, 8, 9% now. But if you average it over the last, 12 years, yeah, no, inflation's only 2.65% or whatever it is. So we're just gonna let it average out and let it play out for the coming several years until people really start realizing that the currency that they've got in their hands is being devalued each and every day. And then possibly we start seeing a spike in velocity, and that whole inflationary situation, I think, can really get out of hand very, very quickly. I think people are starting to wake up to it. And this is why I think buying gold and silver right now, adding to gold and silver positions as they've been smashed down. And I know it's difficult. People don't like buying things that have been smashed down. But I am a natural contrarian by nature. And as an investor, being a contrarian investor has definitely served me well. I like buying things when they're smashed down. Because that's where I make my profits, on the buy, not the sell. And I think what we're seeing and what we're going to see in the years ahead is going to be tailwinds for gold and silver. So to be buying gold and silver right now in as they've been smashed down, for me anyway, and this isn't financial advice. You guys don't listen to what I'm saying here and don't go follow. This is just me, what I'm doing. I love it. I just bought some more silver last week. So in this chart, possible inflation drivers, political disarray. Well, like I said, this energy crisis could turn into a political crisis where, we know what happened in the Arab Spring. So when people can't feed themselves, you're going to get social destruction. And so I think things are going to get worse as the energy crisis worsens, as we move to this woke ideology, this what the World Economic Forum and United Nations and all these elites are pushing. I mean, I'll be honest, I've invested in some of these technologies, and guess what? They can only work, and we only make profits with taxpayers' money. So what we do is we take from the middle class in particular, because everyone always gets takes from the middle class. So you take taxes from the middle class to give to the wealthy investors who invest in these technologies, and then we cash out. And that's what I've done. You cash out because now there's a political pressure on the big oil companies and the big mining companies to acquire these technologies and these firms and whatnot, to say, hey, we got net zero this, or our, man, I could do a whole video on this topic, but yeah, the tubes won't let me. So what I recommend doing is go to Chris McIntosh's website, Capital Exploits. Follow him. Follow his blog. You'll love it. You'll know how to invest. Well, we called oil, we called coal, and when everyone last year was saying, fossil fuels are done, coal's done, oil's done. Well, what did we do? We called it. And we've profited extremely well over the last 12 months on these two players. And more possible inflation drivers, freight costs. We've seen freight absolutely skyrocket. And that's not going to come down anytime soon. Yeah, it will at some point. It will moderate. But yeah, anyway. And so what does this mean for gold? Well, I love this chart. This goes back to the year 2000 and measures gold's performance in major currencies and has the averages there. And you can see that since 2000, gold has performed really, really well. 2013 was not a good year for gold. And to be honest, 2021 hasn't been a great year for gold either. Let's be fair. Let's be honest about that. Take those 2 years out. Even 2015 was a bit of an average year, but most other years gold has performed really, really well. In fact, over that time period, 9.2%. So I think it's wise to have gold as a part of your portfolio. If you look at Chris Cole's Dragon portfolio, he recommends, I think it's 18 or 19% of your portfolio should be in gold. Others say 10%, others say 15%. And when you actually look into it, when you actually add at least 10% of gold to your portfolio, your overall portfolio actually performs a lot better. Throughout history, when you back test that, it actually performs a lot better. So, some people like to go all in gold. That's not me. I'm not an all-inner. That's not how I roll. But I think having gold as a portion of your portfolio, physical gold, physical silver, gold and silver explorers, gold and silver miners, absolutely play a part in my portfolio. And there's times where I am accumulating it and I'm overweight, and there's other times where I'm underweight. And sometimes, especially with my silver, there's times where I'm completely out of silver and I've completely sold. Gold, on the other hand, I've always had gold as a portion of my portfolio. But that's just me. That's not financial advice. Anyway, what do you guys think? Do you think we're about to see a big increase in demand for gold? Are we going to see some sort of reset to get out of this debt mess that we're in? This both fiscal, household, corporate, and government debt mess. There's certainly more and more people talking about it. Some of the arguments absolutely make sense, because other than that, I don't see how we get out of this mess without a massive deflationary bankruptcy, global bankruptcy, depression. Anyway, love to see your thoughts in the comments below. If you like this video, please hit that like button. Really do appreciate it. Take care, everyone, and I'll see you again on another episode of Finance Uncut.